The directors and officers insurance market has seen its share of turbulent times in recent years, and it continues to face headwinds into 2022. I'm Lori Chortis for Ambest TV. Joining me now to discuss a new report on the D&O market is David Blades, Associate Director, and Christopher Graham, Senior Industry Analyst, both of Ambest Industry Research and Analytics Department. The report notes sizable rate increases the last several years. Is it having enough of an impact?
So far, it does seem to be holding at least profitably, so we think they are having enough impact. Really, what we'll know more when we see fourth quarter results and year 2021 in total.
To what extent is litigation funding impacting the D&O line?
Yeah, this has been the big change in D&O over the last few years. Third parties funding the claims, so we're getting claims that we might not have seen in the past simply because a claimant might not have had the money to go after it. Now they do, thanks to the third party litigation funding. And this is not something specific to the U.S. either. We see this in Great Britain, we see this in Australia. So it seems to be a global trend.
How are special purpose acquisition companies or SPACs affecting coverage and cost?
All right. Well, just for the purpose of clarity, I'll just mention that special purpose acquisition companies or SPACs, basically what they do is they offer an alternative to traditional initial public offering or IPOs, and they've emerged as a very significant part of the financial transaction market. Basically, what a SPAC does, it's a company that is formed strictly for the purpose of publicly raising capital to acquire an unidentified public company or a target company. The value of SPACs is that they offer, they've offered some, companies the ability to reduce costs a little bit from a standpoint of going public, and they've also allowed private companies quicker access to public markets in the interest of raising capital. So what we've seen is over the last few years, the COVID-19 pandemic has brought all kinds of turbulence and uncertainty to the marketplace. And many late stage private companies have been hesitant to go public in that environment. So those market conditions basically then have helped cause the creation of SPACs and basically what we've seen as a explosion of SPAC formations in 2020 and 2021. Concerning now how SPACs affect D&O coverage and the cost for that coverage, IPOs inherently bring the risk of federal securities litigation brought by investors in new public company formations. So the same risk is present for SPAC-related transactions as they are for regular IPOs. So again, you still have that susceptibility to federal litigation and securities lawsuits. So basically, the directors and officers that are subject to those suits, emanating from SPAC transactions, they look to their D&O insurance for coverage. As such, there's been an explosion in the demand for D&O insurance related to the proliferation of SPACs, and that's also led to an increase in litigation and regulatory risks for directors and office insurance from that standpoint. Basically, we've also then seen that cause some pullback for insurance companies that are providing insurance or providing D&O or related to SPACs. We've seen a little bit of that in the marketplace in terms of them being a little bit more reluctant to provide the coverage for SPACs based on the evolving risks that are involved with SPACs as far as that's concerned. But that reduced coverage then causes increased costs for those who can get the coverage from the insurers that are still in the marketplace. So it's definitely a part of the marketplace that's evolving, but it's been very impactful in the last couple of years.
So are there any bright spots in this market?
Well, this kind of goes back to what you started with earlier. It does seem like price momentum through 2021 was generally positive. Now, what we did see is through the second quarter of 2020, prices were accelerating at an increasing rate, or they were going up an increasing rate. We kind of saw that flatten out a little bit towards the end of 2021. So the thought process is that, at least from that standpoint, there's some, there's going to be less turbulence, and there might be, a little more settling overall of the marketplace, and opportunities, obviously, for those that need the coverage to get the coverage. And maybe it'll, again, flatten out from a pricing standpoint. But to the point of your first question, ultimately, what's going to matter is whether prices over time have increased to the point where they're actually covering loss costs, which have been rising due to a number of different reasons: social inflation, rising, federal litigations, securities lawsuits. So it is positive that rates have risen to a point where we believe premiums are a little bit more adequate, but that's actually going to be tested over time to see if it proves out in terms of ultimate bottom line results. So again, there's optimism in the marketplace because of the capacity that's available. And like I said, a lot of that capacity was driven by the attraction of the high rates, but we'll see over time if that truly results in bottom line profitability.
David and Chris, thank you so much for joining me today.
You're welcome, Lori.
That was David Blades, Associate Director, and Christopher Graham, Senior Industry Analyst, both of AM Best Industry Research and Analytics Department. For AM Best TV, I'm Lori Chortis.